Hello learners, it's my pleasure to welcome you again to our today's session. We will be introducing a new topic, which is Introduction to Risk and Return. Introduction to Risk, Introduction to Risk and Return. Introduction to Risk and Return. This is a new topic that was introduced in the financial management syllabus in the year 2018. So we are going to start off by defining the term risk. What is risk? Risk may be defined as the potential for unfavorable returns. Potential for unfavorable returns. So risk has a special meaning in finance, whereas the dictionary may define risk as danger. In finance, we define risk as potential for unfavorable returns, which may be occasioned by variability of returns on investment. When an investor, when you invest in an asset, when you buy a financial instrument expecting to earn a return of, say, this is expected return of, say, 20% expected, but that is after, say, 1 year. After 1 year, you expect 20% on an investment like, say, a share. You buy a share expecting to get return of 20% after 1 year, but you actually earn 15%. So if the actual return is 15%, instead of what you expected 20%, you see there is a variation here of 5%. So that would mean such an investment is a risky investment. But if you are to earn, say, 5% instead of 20, then you see there is a variation there of 15%. That would mean that share is more risky than the first one. So risk is the potential for unfavorable returns. But where the actual return is equal to the expected return. Okay? If you are expecting 20% return, expected return. If the expected return is at 20% on investment, and the actual return turns out to be 20%, you invested in a share, you invested in a bond, you invested in an asset, and you are expecting to earn a certain return of, say, 20%. And it turns out that you earned the 20%, then we say such an investment is risk-free. That is a risk-free investment, meaning there is no risk. No risk. Because remember, we are saying here that risk is a potential for unfavorable return or variability of return on investment. Here there is no variation. You expected 20, you earned 20%. So there is no risk. So in simple terms, that's how we can define risk. Risk is the potential for unfavorable return. Where there is no variability in expected return, then there is no risk, or such an investment or an asset is risk-free, meaning free of risk, meaning free of variability in expected returns. So we'll move ahead and look at the components of risk. Components of risk. Now, risk can generally be categorized into two. One, the systematic risk, and two, the unsystematic risk. The unsystematic risk. When you combine both the systematic risk and the unsystematic risk, you get what we call the total risk. So total risk is equal to the systematic risk plus the unsystematic risk. The main components: systematic risk and number two, unsystematic risk, giving us the total risk. The total risk. So we will now answer the question: what is systematic risk? What is the meaning of systematic risk? Now, the dictionary defines systematic as acting according to a fixed plan or system. Acting according to a fixed plan or system. A risk simply means, systematic means acting according to a plan or system. Now, in this context then, systematic means systematic risk is the risk that is caused by factors beyond the control of individual investors. They are known as system factors. System factors is the uncertainty inherent, the uncertainty inherent in the whole system or economy or market. Okay, this is risk that individual investors have no control over. For example, the political factors. Risk that is caused by political factors. If the political system is upset, then the losses, the variability in returns that may result from political instability may affect all the players in that country or industry. And the individual businesses have no control over such factors because it affects the whole system, Then there could also be economic factors. When, for example, a country is going through recession, that recession affects all the players in the economy, all the companies, all the individuals, so that the individual investors do not have control over such factors. So these are system factors. So the variability in returns that is caused by such factors that individual investors do not have control over, they are known as system risk. So I've given just two examples. We could have social factors. For example, change in preference of consumers, the general change in preference, then that would lead to systematic risk. Then having answered systematic risk, then we can now answer the question, what is unsystematic risk? Now, unsystematic risk is the opposite of systematic risk. This is the opposite of systematic risk. And systematic risks are those risks that are unique to individual investors or companies. Those are risks that can be avoided. Those are risks that can be diversified, as opposed to systematic risk where diversification may not be possible. If the entire country is going through recess, you cannot diversify your investments because all businesses are going through tough times. There are low returns which are posted by all companies or industries in that country. So you cannot diversify. But for unsystematic risk, these are risks that can be diversified. These are risks that are caused by factors specific to the company and specific to the company issuing the securities. If a company is issuing, the company that's issuing securities, the unsystematic risk is specific to that company. For example, the financial risks. We can give examples. Number one, even before financial, you have the business risks. Business risk is an example of unsystematic risk. We have two, financial risk. Financial risk is another good example of unsystematic risk, and we are saying is specific to the company offering the financial asset, for example, securities. So now, what is business risk? So business risk is also known as operating risk and is related to what we call the earnings before interest and tax. Earnings before interest and tax. And these risks, the operating risk or the business risk is associated or comes as a result of the way in which a firm organizes its funds. The way a firm decides to organize its funds in generating revenue, earnings before interest and tax. There are those companies that invest a lot in the fixed costs. So there are two main categories of costs: fixed costs and variable costs. Fixed costs and variable costs. If a company, for example, invests a lot in fixed costs and the business does not perform well, then there is a risk of variability in returns. There is a risk of variability in returns where there is high fixed costs and low business. So business risks, I've said, is also called operating risk, and it arises due to the chances of variability in return caused by a firm's decision to or pattern of usage of funds, because every business establishment mobilizes funds and uses funds for its business operations. For example, a company may have one company may have used a large portion of its funds on fixed assets, while another company may have used only a small proportion of its funds on fixed assets and the balance on current assets. So firms choose. So if you invest more in fixed assets and the company is not performing well, they are low profits, then there is that chance or potential for variability in returns. Then there is this financial risk. Financial risk. What is financial risk? Financial risk is an example of unsystematic risk. It's a good example of unsystematic risk. So what is financial risk? Now we need to appreciate that all companies use both equity and debt capital. Companies have a choice of using equity or debt capital. Equity or debt capital. So a company that has high level of debt within its capital structure has exposure to what we call financial risk, is exposed to financial risk because debt capital has a fixed rate of return. So if you borrow money from debenture holders or bond holders, then there is an obligation for the company to pay the interest on the borrowed funds. So the debt capital, I'm repeating, is interest bearing. Irrespective of the prospects of the business, interest on capital must be paid. Irrespective of the performance of the business, then interest has to be paid. In other words, interest payable is fixed for a given amount of debt capital irrespective of the volume of business. And if that is the case, then the company may be exposed to financial risk. That's why I normally say a company is in financial crisis, because the company has borrowed money but may not be able to repay, may not able to pay interest, may not able to service the loans. So the company may run into financial risk, which is a good example of unsystematic risk. This risk is controllable. Company has a choice of raising funds or raising capital through the ownership securities like shares, preference, share capital, and so on. So financial risk is an unsystematic risk because the capital structure is in the purview of the management. The management has the power to decide on the capital structure. So this risk is unsystematic. It is the management that chooses to have debt within the capital structure. Remember, there are two main sources of raising capital. There are two main sources, just to remind you. That is equity and debt. Equity and debt. You have seen the financial risk is related to debt. Financial risk. So a company that has debt within its capital structure. If a company has debt within its capital structure, we say that company is levered. That's a levered company. Where a company has no debt within its capital structure, then that company is termed as unlevered. Unlevered firm or levered firm. It may also be termed as geared. You can say that firm is geared or ungeared. If there is a high proportion of debt within the capital structure of a company, then we say that company is highly geared or highly levered. If the proportion of debt to equity is low, then we'll say that company is lowly geared. Lowly geared. Remember, we are talking about capital structure. The capital structure, the total capital of a firm will be equal to the equity capital plus the debt capital. So, for example, if a company has 1 million or 10 million equity shares, ordinary share capital, and 0 debt within its capital structure, then such a firm is unlevered. It is unlevered. But if a firm has, say 5 million plus 6 million, then this firm is levered. The firm is levered. The firm is geared. And you can see here is highly geared because the proportion of debt to equity is high. So such a firm is highly geared. So where a firm is highly geared, highly levered, then it runs into what we call, it may run into what we call financial risk, which is the potential for unfavorable return. If the business not doing well, if the economy is running into recession, that company may not be able to repay the borrowers or the lenders, thereby causing what we call running into financial risk. So in a nutshell, that's the distinction between systematic risk and unsystematic risk. And with that, we come to the end of our introductory lesson under the topic Introduction to Risk and Return, where we've introduced the concept of risk. We say that risk is the potential for unfavorable returns. In finance, we said risk has a special meaning, and that meaning is the variability of returns on investment. It is the potential for unfavorable happening, which may be unfavorable return. And we have also seen that there are two components of risk, that is the systematic risk and the unsystematic risk. So with that, we hope to meet you in our next lesson. Thank you. and God bless.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.